everybody. This is Patrick MontesDeOca with live trading talk here for April 27, 2022. We go right into the silver market here as we have a trade that we recommended early to our subscribers in our live trading room to go long silver at 23.51. It was filled at 23.51 and our targets are 23.70. If you are long here, what you want to do is trail the position with a stop, at least to lock in your first $300 per contract. And you can, if you get stopped out, you get stopped out, but at least you're locking in a profit for the first trade. Otherwise, hold on to your initial stop at break even or your entry point if you want to maximize the target of 23.70. I would like to take a look at some of the fundamentals that we're dealing with right now. And one of the headlines that is being talked about quite a bit here is China. Everything is halted. Shanghai shutdowns are worsening shortages. The challenges will probably contribute to higher inflation, but come at a time when demand is waning for many items. Thousands of air fryers are stuck in factories, warehouses, and ports in central China, where shutdowns have stalled millions of dollars worth of inventory for Yeti Houseware, a family-run business in Los Angeles. How quickly those backlogged appliances make it to the United States could have a wide-ranging implications across the U.S. economy. As domestic manufacturers and retailers brace for another round of disruptions from recent COVID, related shutdowns in Shanghai, China's largest city. White House officials are paying close attention to the disruptions to monitor the potential impact of the U.S. economy. Things are getting crazy again, said Bobby Dejaveri, the company's president. Everything is halted. There are closures this very minute that are adding to the supply chain nightmare we've been experiencing for 2 years. So one of the things that I'm looking at is obviously the implications that we have of this lockdown that's happening here, and the availability of once again supplies being made available to the U.S. markets and the European economies. So I think what we're going to see, and this is pretty much affecting the commodity markets across the board. It's affecting the energy markets. It's potentially affecting some of the precious metals like palladium. You saw what happened recently here with zinc. So I think we have what is usually called in this business a short squeeze, meaning that the prices are getting caught with short supplies, and the demand of those supplies is higher than the supplies available. And it doesn't appear that that demand has waned or declined in any way. So it puts pressure on the buy and demand in an environment of short supplies. It seems that we are recalibrating the U.S. economy to the reality of really what happened since 2020 when the Feds opened the printing presses. And we're beginning to see that reflected in price. If you locked in your trading stop to your first $300 on the trade, it was accomplished at 23.57. This gives you a little more liquidity for your next trade and just allow for the market to trade around this level here. So what I recommend to my traders basically that are using this methodology is that you don't use straight stops when you enter your position, but you use the straight stops as a trailing stop when the market goes in your favor. And you know, the first target of $300 is a pretty good, reasonable target, and it's right there right now. That would be your first trade, and so when you get out of the trade, it all depends upon also how many multiples you have. You know, if you do multiple positions and you bought multiple positions down here, obviously you can get rid of your first target of $300 profit. If you do it two, you can get rid of one, lock in 300, use that as a cushion for you, and allow for the other one to go to the 2370 target as expected here for the rest of the day. Two things are going to happen. Either the market is going to go to a 2370, or it's going to come down and come down below that 2351, which you can either use it as a protective level, short-term, conservatively, or you can look to add to your position here in this area all the way down to 2338, which is really what I'm looking to do. The fundamentals that are developing here are very bullish for commodities, very bullish for metals, very bullish for gold, very bullish for silver. There is a possibility that the cash markets, meaning physical gold, physical silver, physical palladium, could run into some shortages. And if you remember back in 2020, we had a premium built in gold of about $80 at one point in the cash market above the futures. And so that was the premium that was demanded if you wanted to buy physical gold. It really was not such a big deal, but you're talking percentage-wise, you're talking, the premiums can go up to 30, in some cases 40% above the spot price, which is just incredible. So we're using the futures markets to day trade, but we are looking to take advantage of this position here as it has been pretty much wounded, you might say, over the last few years. The demand for precious metals is probably the lowest in the world in the United States, as opposed to China recommending their people to buy gold on a monthly basis. So I believe that gold is becoming part of the discussion in the monetary system, as it always is, when currency and fiat currencies fail to produce or protect one's sovereign integrity, basically. And that's what's happening here right now. The integrity of the US dollar is being jeopardized by this tremendous amount of stimulus that was printed by the feds since 2020. And we're looking at maybe 30-40% of stimulus that has come into the market since. When you take a look at the balance sheet, the Federal Reserve has amassed total assets that are close to $9 trillion, which is what has to be tapered. This is what they talking about, taking this money supply out of the market. They, I believe, what it appears has happened is they have overstimulated the economy. And so to be able to taper from this balance sheet to a normal level is going to be pretty difficult to do. The pressure that is building underneath is the economic pressure of inflation. And by taking money out of the system, the liquidity will decrease in the money markets accounts, and potentially we can have another credit squeeze, as we did back in 2008. A credit crunch. The liquidity in government bonds, I believe, usually under normal conditions is about 28%. It has declined to about 12%. And we're going back to levels of 2019 when the feds began to inject $120 billion a month in purchases of government securities. It wasn't publicized. It was very quietly done. So we want to pay attention to what the feds are doing here. What basically appears to be on the face of high interest rates. The 10-year bond is trading at 276, 277. We saw it trade recently close to 3%. And this is the dilemma, that even if the rates go up to 3.5% or 4%, which is getting into danger territory, you're looking at a deficit, a negative yield of about 5% according to government figures. If you use shadow stats, the inflation factor is running more like 16%. And so, you're looking at a gap of about negative 13% on yield. This is the formula that was used in the 70s and 80s. And if we're going to compare the current economy to the inflation of the 70s, then we have to include these formulas. We can't use current formulas that have been adjusted, manipulated to current pricing when you're looking at a 40, 50-year data. It doesn't make any sense. You have to use the old formulas, and if we're using the formulas by shadowstats.com, you're looking at a tremendous negative yield, which is potentially going to cause a tremendous amount of volatility into the markets. And the more interest rates push up here, you're talking about a leveraged system that could potentially collapse. The economy is highly leveraged. They have printed, if they print 30-40% of money, obviously you have assets that are running on the upside 30-40%, like real estate, hard assets, land. But it doesn't mean that you are becoming wealthier. What it simply means is that one is washing out the other, and you're not gaining anything. So the big question is here, what are interest rates going to do? And so far, if you take a look at the interest rate markets, they have done the job of the Feds. They have gone up to almost 3% on the 10-year note, while Fed funds are 0.25%. And the 10-year note has gone up from about 0.33% in 2020 to 3% as we are speaking here recently. That is a phenomenal move for interest rates to go up in a short amount of time. And so what happened here is basically the Feds got behind the curve, and the market has always dictated where interest rates should go. And so we have seen 3% based on market demand, pushing the yield, the 10-year yield, at 3%. The thing that I'm looking at and is potentially very dangerous for the economy is that you're looking at the 5-year note being inverted. Being inverted to the 10-year note, meaning it's higher than the 10-year note. That relationship indicates potentially that we could see a recession. It's a very dangerous relationship because the money is going into short terms out of the long term, out of the 30-year bonds. And even though we've kind of gone to par right now, it's about 277, 278, it's adjusting itself, but it's indicating the possibility that this is one of the first signs of a recession unfolding, potentially. So we want to obviously keep an eye on the supply situation here that we're dealing with and causing potentially more issues with supply. Let me come back to the market here as we are trading the standard deviation of silver right now and the reversion to the mean. What you saw here on this early signal was the market come down early to test the daily level of 2338. It activated a buy trigger, completed the target right away, and activated a weekly trigger from 2351. The target was 2370 completed early this morning, and we recommended our traders to basically go long on this trade. And this is the trade that we've locked in the first $300. So now the market met the target. This was the mean or the standard deviation target that was completed, and this target is 50-50 standard deviation, so it could go either way. That's why we if activated from below, we use that as a target, we go neutral, and we wait for the market to tell us basically, again, what the momentum wants to do in the market. So here, by coming down below 2370, it activated the target of 2351, as you can see, which was completed again. And the market trading now above 2351 at the end of this 15-minute bar that we use to execute, it will activate another buy trigger, another trade. So we locked in our first $300, and now we're watching the market activating another signal, and it's up to you to make that choice if you want to double dip or go back into the market. But I'm showing you basically the relationship of the momentum of the market in terms of these prices here. So what it means here is basically as the price comes down into this blue level, the algorithm identifies the standard deviation to be about 90% probability that if the price comes down to these levels and reverts, there's a 90% probability that it will revert back to the mean. And this is the confirmation of that analysis. And the same thing below. But the average price in green is a pretty choppy area, so I don't recommend to for young traders or for traders that can you might say can't handle the kind of volatility. Then you wait for the highest probability, and that is when the price comes down into the blue levels or it goes up into the red levels. And if we open up the chart to the daily chart, you can see the price reaching above the weekly 2696 sell one level. Was in red, and in red it means that it is the area for distribution of supply, where you can expect sellers to come into the market once the price is reached. And the idea is that it will bring the market down to the extreme below the standard deviation, and that would be the blue levels. And we are trading those levels right now. We are at basically those levels right now. And we are looking for demand. We're looking for demand to come into the market by turning the bars into green. From these levels, the expectations are that the market will revert from here. So I'm looking to be a buyer. I recommend my traders to look to trade the long side. And if you want to get a second trade done here, you can buy the market on a close above 2351. More conservative, you want to wait till the close. Whatever the close is at 7:30, you can buy at the market at that point. And it's up to you how you handle your trade, whether you're a multiple trader, multiple position trader, or mini trader, depends upon your profile and appetite for risk. $23.51 is a very strong indicator, a very strong trigger point. It is a weekly trigger point. And we're going to jump right into as an aggressive trade and buy one silver, 23.52. And once you enter your position, you can use 3 levels of stops. The first one is the most conservative, is a close below the pivot point used. The second one would be a dollar amount, maximum dollar amount that you will have on the trade, that regardless of the market, if it comes down to those levels, you get out at the market. And the other one is basically waiting until the close and be prepared, to add if you want to. This is a good strategy if you're a multiple trader, multiple position trader, and look to add on a close or on a activation at 23.38 if we come down there. This, once again, this whole area in blue represents accumulation of supply. It recommends for you to accumulate supply at these levels. So, depending upon your money management technique and risk management, you can use this as a GPS to guide your trading. So continue to hold if you're long your position. And your first target would be 23.70. Second target is 23.91. And you can use a close below 23.51 conservatively, or leave it open, manage a dollar risk, a dollar stop, and look to accumulate in this level. In the meantime, my friends, I hope you have a great trading day here. Have a great trading week, and trade from the long side. All the surprises are going to be on the long side. We are at a critical point. Major support levels. Accumulate supply.